Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is February 6th of 2023. This is the first update of February, and we're certainly glad that everyone could join us. We had a huge week last week when we think of just the number of events and updates that were thrown at the market. We had the Federal Reserve. We had corporate earnings from some of the largest companies on the planet. We had the unemployment report on Friday, and then a host of other economic updates, such as the ISM manufacturing and new orders data, unemployment claims. So there was a lot thrown at the market. Overall, I think the market skated through the entire week as a whole in pretty good shape. The first half was pretty constructive. The last couple of days had a bit of a check back, but that's to be expected after 4 pretty healthy weeks if we think about a starting 2023. So let's go ahead and get started. And really what we wanted to do this week was really help everyone parse out what happened last week, make sense of it, and then, how are we navigating through the current environment? So bottom line here, despite all those doomsday headlines that continue to impact the market, hiring is accelerating across the country. I think that's really the bottom line statement when we kind of think of last week. Huge non-farm payrolls number exceeded expectations by close to 300,000. We have an acceleration of job openings, almost half-century low numbers as it relates to unemployment claims. So all that's good news, and that's really the point here, is that good news is good news, and we're going to go through that. Number 2, the technical setup for stocks as we enter into month 2 of 2023. And then, of course, reviewing new leadership versus that old regime. We've had a lot of short covering in many technology stocks, so we want to make sense of that. So on Friday, we had that non-farm payrolls number, as we can see here, 517,000 jobs created versus 188,000 expected. I don't remember many reports going back 20 years where you had such a beat of expectations. I mean, it was truly a fantastic report. And you're going to have those people out there that are talking about the payroll adjustments and all this stuff, seasonal adjustments. It was a good report. Okay, let's not make this more complicated than it needs to be. And here's why it was a good report. Not just because of the number of jobs created, but also, as you can see here, big surge in January, but also the breadth across the different industries in terms of where that job growth came from leisure and hospitality to professional business services, the government, all the way down to manufacturing and construction. Everything was pretty healthy as it related to hiring activity. The other big point here that I want to point everyone to is the continued deceleration. This is a chart here on the bottom right, that continued deceleration of the year-over-year hourly earnings. Why is that a good thing? We're getting a pickup in hiring, but a deceleration in some of the biggest inflationary forces out there, and one of the biggest being hourly earnings. So if we get that deceleration in hourly earnings, we get that pickup in activity as it relates to job hiring, we get that pickup in the overall economy, that's kind of a Goldilocks scenario, and dare I say, a soft landing. I know it's almost a banned term, but almost no one's expecting a soft landing. Imagine if we got it. So this was a good report. Then the next thing we want to kind of point everyone toward is this idea of what the Federal Reserve is saying and doing versus what the bond market is saying they're going to actually do in the back half of this year, right? So first thing, we had that FOMC meeting on Wednesday. There was 2 pretty dovish moments in that meeting. The first was when the Federal Reserve, head of the Federal Reserve, Jerome Powell, said, I will say it is gratifying to see the disinflation process now getting underway. That's not something you bother saying if you really think that inflation is going to accelerate. Now it might, right? Who knows what happens in the back half of this year, especially with China reopening. But the fact that he's saying that says that the Fed is starting to look toward the end of the hiking cycle, and then what happens after that. And that's really what the market was focused on. And then the second thing was when Powell said, I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. So we kind of threw away this whole idea that the Federal Reserve sees the stock market rallying and therefore wants to put a kibosh on it to control inflation. They're kind of more focused on some of the long-term picture. Whether that's right or wrong, that's outside of my pay grade. I focus on the statements that matter and move asset classes and asset prices. And this overall is generally being perceived as a fairly dovish statement. Now, where I'm more concerned about, not concerned, where I spend more of my time and focus and energy on is what is the bond market saying as it relates to the Fed. So what we see here is the blue line is the Federal Reserve interest rate policy, so the FOMC policy rate. So we can see that clicked up to 4.75%. But here's the thing. Notice what the 2-year yield has done. For the first time since this tightening cycle began, when the Federal Reserve started increasing interest rates, the 2-year yield is trading underneath the FOMC policy rate. And in fact, actually went down on the day that they increased that policy rate. Why is this important? It's important because the bond market votes on what they believe based on all the incoming data every single day on what they believe federal policy rates are going to be in the future in real time versus the Federal Reserve only meets once a month, once every couple of months to set those policy rates. So we can notice here is that we go back to 2019, the 2-year yield already started to price in rate cuts well in advance of that first rate cut in mid-2019. We can see that gap open up here. Same thing happened last year, right? Inflation started to race ahead. Federal Reserve is like, don't worry, it's transitory. No. The bond market sniffed it out, and we can see here the 2-year yield started to race ahead of the policy rate, with the policy rate eventually catching up. We're now seeing that opposite thing come to pass, which is the 2-year yield diving as the FOMC policy rate moves up. So if you believe the bond market, you're believing that, hey, you know what? There's the potential for rate cuts in the back half of this year. Whether that happens or not, we'll have to wait and see. So what's investor sentiment like right now? You would think it's fairly bullish given the move we've seen in the markets, given the move we've seen in some of these speculative trash areas of the market, such as the ARK funds and such as these nonprofit technology companies. It's still fairly bearish, believe it or not. So when we look at the AAII Bull Bear survey, we see is most investors remain pretty bearish. And this is a pretty bullish setup in our opinion, because when investor sentiment remains this bearish, despite an upward advance, we call that the market climbing up this bullish wall of worry. So you're throwing problems at it one after another, and it just continues to advance. And that's climbing the wall of worry, and it's dragging people into the market because a record amount of institutional money managers are sitting on elevated cash levels. Remember, they're paid to manage money. They're paid to invest. And so the longer the market advances, the more pressure it is on them to start putting that cash to work. And so that's what we're beginning to see right now. Now, there is risk there in the market. Of course, there's always risk in the market, but where do we specifically see risk concentrated? We've had a big move in the last 2 weeks in the NASDAQ and a lot of profitless tech companies, the ARK funds, those types of speculative stocks that really got drilled last year. We've had this short cover rally. I want to make sure that everyone understands that those stocks remain in a downtrend from a technical perspective. So if we look at this chart here, this is the QQQs relative to the equal weight S&P 500. Again, we can see here in a defined long-term downtrend, we've had about a 9% relative strength rally. So in other words, 9% outperformance versus the S&P 500. That takes it right up to those multi-year resistance levels. This is not, in our opinion, a time to be doubling down on profitless tech. If you had a trade in it, awesome, congratulations. We think that now is the time to be taking profits, lightening up on that risk, and then shifting into areas where we see emerging long-term durable leadership. So the question really is like, where is that leadership? And we're seeing it in small caps, we're seeing it in the old economy stocks, we're seeing it in commodities. And we can see here, this chart here on the right shows small caps breaking out relative to the S&P 500. And small caps bottomed months ago, right? They bottomed way back in October and November versus we think of some of those growth stocks didn't really bottom until December. So that's a sign as you're coming out of a bear market, what are the areas with economic sensitivity that bottomed first? That's kind of a clue as to where some of the leadership may reside. The other thing I do want to point out here is that we are coming off a very negative year in the stock market. 53% of the time when you've had a negative calendar year, the following year, the S&P 500 is up more than 20%. Now, we're not saying that's going to happen. We're just saying that when you have a calendar year that is negative, the chance of making an excess rate of return above historical averages is actually pretty good. Now, that's 53% of the time where the S&P 500 goes up more than 20%. There's what another big chunk of time here. Call it another 30, let's see here, probably 30% of time where it's positive. And then the 11% of the time where it's between -5 and 5%. And of course, you have a couple of times where it's down more than that. So the bottom line here is we like the historical setup for stocks after last year's negative year. Now, we talked about that regime change. I want to review some of the slides that we talked about for the last couple of weeks. Old leadership looks like something like Microsoft or Amazon or Google or Facebook. We think Facebook, if anything, you put a gun to our head and said, hey, you got to buy one of these things. Probably Facebook is the most attractive because of its cheap valuation. But when we look at Microsoft relative to the S&P 500, a clearly defined double top. It looks like a stock that is tired. It looks like a stock that all that growth is priced into it already versus something more vibrant like a BHP or a Rio Tinto or many of the international mining stocks that we see out there, or the banks or the industrials that continue to hit new highs. That's what we want to see as we're exiting a bull or a bear market, is where is that emerging leadership? And, a picture says 1,000 words. So this is the S&P 500 weight in technology versus energy, materials, and industrials. And we can see here, after a multi-decade trough, we believe that technology and this old economy group of stocks will converge, with the old economy at some point surpassing the weight of technology in the future. Why? Because they think the stocks are incredibly cheap relative to technology. Their earnings are improving and they're under-owned and maligned across all of Bay Street, or Wall Street, pardon me. That's my Canadian background there. And then, of course, when we think of the other big move in international versus the U.S., U.S. outperformance versus their global equity peers is at a 3 sigma deviation. In other words, 3 standard deviations above that historical mean. Again, a picture says 1,000 words. When you get this type of movement, we do believe it makes sense to position for that mean reversion over time. That means looking at companies in the US that got international revenue exposure. That means looking at international markets such as Europe or Japan or China or the emerging markets. We think that is going to be, in our opinion, a source of outperformance, otherwise known as alpha. So bottom line is, we do believe that good news is good news. And we think that this is a sign of economic vibrancy and health. And we don't want people losing their jobs. And we shouldn't be buying stocks, and that shouldn't be our bull case because people are losing their jobs. So we think the fact that the jobs report came out and was good is a good thing. So bottom line, soft landing may indeed be possible, but no one wants to believe it. We like that setup as it relates to stocks. Market participants remain utterly bearish, and we do believe that a regime change is at hand within the market, away from the new economy and the U.S. hypergrowth areas of the market and toward the old economy, international, emerging markets, those types of areas. So that's what we got for you this week, 888-543-3776. Thank you again. Have a fantastic week, and we'll speak again soon.